I'm Deborah DeRoy, and I'm here at Columbia Threadneedle Investments to discuss with Mark Burgess recent events and the themes affecting the world of asset management. Hi, Mark.
Hi, Deborah.
Now, it seems that we've had a very rocky start to the year, but world equity markets have recovered their poise. What has changed?
I think a couple of things have changed. Firstly, valuations got relatively attractive versus where they had been. Equity markets fell quite a long way, and I think that attracted some of the value buyers into the equity market. And secondly, we saw the ECB extend its monetary policy measures, extending the QE program, extending the bond buying program, and extending the liquidity provision program, and all of that led to a big snapback in markets, both credit markets and equity markets.
Now let's move on to the topic of the US. Is the economy struggling? And what is the outlook for interest rates?
We obviously saw the first interest rate rise in many, many years at the back end of last year, and almost as soon as that happened, we saw the equity markets sell off and concerns rising about slowdown in China and what that might mean for the global economy, and then the consequent fall in commodity prices and what that might mean for the financial system. So the pressure was immediately taken off US growth, and as a result of that, the expectation for interest rate rises have moderated very, very considerably. And I think Janet Yellen, Chairman of the Federal Reserve, said yesterday that we might see another rate rise this year, but probably no more than that. So that's the first thing that happened. And the second thing that happened is the oil price fall that we saw led to a big reduction in spending in the shale oil sector in the US. So we've got something of a manufacturing recession in the United States as we speak, as a result of that fall in the oil price and the contraction in the shale oil sector. So when they put interest rates up, almost immediately the pressure came off for those two reasons. And as a result of that, we think the outlook for US rate rises are much more moderate than we did before.
Okay. Now, what is happening to the US dollar and the currency markets? They were all in the news, but it seems that it's gone a bit quiet.
It has, and I think it's, again, follows on from the monetary policy measures we've seen in the United States. So the US dollar had been very, very strong as a result of both a strengthening US economy, but also expectations that interest rates in the US would rise as a result of that strengthening US economy. As we've just discussed, we now aren't expecting monetary conditions to tighten so much in North America. And as a result of that, the pressure's really come off the dollar, and it's been much more muted in the last few weeks.
Now, last question on the United States following that. Do you think that there is a looming US recession?
I don't think there's a looming recession. I do think growth will be more muted than we had previously thought. So the oil price fall is unequivocally good news. The US consumer is 70% of GDP, and they focus very, very much on how much it costs them to fill their car up every week. And the price of gasoline has fallen a lot, and therefore they're better off. So that's a good thing. But as we've just been discussing, some elements of US manufacturing are in recession because of the fall in the oil price and the contraction in the shale oil sector. And so net, we think growth will be the kind of 1.5% to 2%, but not much more than that, which is still good relative to the rest of the world, but isn't anything that's going to get too excited about.
So no reason to be really concerned yet. Okay. Now, you've just mentioned the impact of the US economy onto the Chinese slowdown in growth. Are you worried about the outlook for China?
We clearly were very worried about it, and spoke about that a lot during the course of last year and the beginning of this year. The most recent statistics have been more positive for China. They appear to have stabilised the economy. We've seen some investment spending pick up, and the most recent statistics suggest that growth is coming through again. That's good in the short term, but it doesn't really solve the longer term problems of an unbalanced economy, an economy which is still relatively indebted, and where we've got to deflate without damaging the economy some asset price bubbles that have built up over the years. So in the short term, it's probably okay. I think in the long term, they still have to grapple with the longer term issues that we've discussed at length.
It seems that emerging markets are doing well again. Why is that?
We've had a number of things happen. So last year, the emerging markets did badly because the dollar was strong, oil price was falling, and the Chinese economy was slowing. So we've got the reverse pretty much of all of those things. The dollar has stopped strengthening. The oil price, albeit still low relative to history, has risen from the mid-20s to $40 a barrel. China, as we've just said, is probably doing a bit better. So all of that has very much taken the pressure off the emerging markets and has allowed them to bounce back quite sharply. And in addition to that, when they fell heavily last year, valuations again started to look quite attractive. So you've had a valuation support as well coming through.
Now, the UK is soon to vote on whether to stay in the EU. What are the implications of this?
Well, we've seen a lot of pressure build up on sterling, and the currency's fallen about 12% from the peak. So that's had an immediate impact, and the sterling continues to be under pressure. We've not seen it follow through yet into the bond market. The gilt market is still relatively well supported, and it's not followed through into the equity market either.
Yeah.
Perversely, at the margin, a fall in the currency is positive for the equity market because 70% of FTSE 100 earnings come from overseas earnings. But were we to vote to leave the EU, I think that would impact the currency further from here. We'd probably see another 15 to 20% fall in sterling, and I think that would unsettle certainly financial assets in the UK for a while, as well as financial assets in Europe. So I think it'd be a bad thing for both UK and European markets.
A negative impact for us.
Yes.
Yeah. The high-yield debt market looked to be heading into a crisis only a few weeks ago, but now it seems everything is back on track. What has happened, and is it sustainable?
I do think it's sustainable. Two things happened. Firstly, yields got to levels which attracted buyers in. The valuations looked attractive, and I think that led to some buying and led to the markets bouncing back. But more importantly, we saw the extension of the policy measures from the ECB, where they extended their program to buying corporate bonds. Now, whilst they're not buying high-yield bonds specifically, they are buying investment-grade bonds, and as they have rallied, that has led to a rally in the high-yield market. And I think that's going to be here to stay. The ECB certainly is going to have this bond buying program in place for some time. So there's an underpinning to the investment grade market, which in turn will underpin the high yield market. So I do think it's sustainable.
Okay, good. Well, that's a very good point to end on. And thank you for your time, Mark. And thank you for watching. We'll be back again next month.